budgeting. And the idea of using capital budgeting is significant in terms of how corporations make decisions around investments in general, while they're expanding, while they're doing their business, while they are kind of conducting their business year on year, right? So that's the primary discussion point that is going to come here. What is capital budgeting? So we're going to discuss what is capital budgeting broadly, how is it done, and then what are the key issues or basic introductions around with the capital budgeting data points that come, and how do we kind of deal with those issues as we go along, right? So this is going to be largely an introduction kind of a segment, trying to understand what are the key components of capital budgeting. So what is it exactly? Every firm needs some idea about what future levels of investments will be in due course of time. So most major firms would undertake an exercise at the beginning of the financial year called capital budgeting. Now, what happens? Let's say there is a firm, and there is a larger firm, and there is a unit 1, there is a unit 2, there is a unit 3, there is a unit 4, and the overall firm actually entails all these units put together. There is a senior management who expects all these units to give some sort of forecast for the year. What are these guys going to do? What are these guys going to do? What is the project that unit 3 will undertake? And what is the project that unit 4 will undertake? All projects are basically analyzed using the tools that we have seen so far. So your NPV analysis, your IRR analysis, your payback period analysis, those are the tools that are used to kind of identify what projects need to be taken. And this data is then submitted to the senior management. So under capital budgeting, typically the middle management of various business segments or various units or divisions in the business would submit their project bids to the senior management, and then the senior management would decide on where exactly they should allocate the firm's capital. So it's like, how do you budget the overall capital that is available with you? And that's why the term capital budgeting. So you're trying to essentially allocate or budget the capital across various projects, right? Now, that seems to be a logical exercise when you're running a business, and it possibly makes sense to kind of do for all firms. Uh, in general, there are, however, certain issues that kind of crop up. There are some very basic issues that come in. Note, how does this process work? Each of the units is going to give a forecast, right? So each unit gives some sort of a project forecast to the senior management, right? So that's a forecast. Remember, they're trying to guess, or they're trying to project what is going to happen in the future with this particular project. So obviously there are certain kind of biases that could possibly creep in. What are these biases? The first one is biased forecasts. Now, each unit manager, unit 1, 2, 3, 4 in our case, each unit manager will have a very optimistic view of his or her project, right? That makes sense, because, why would this particular project manager say bad about his or her own project? Usually, it's not because they want to show their project to be good, but because a lot of the times they genuinely believe. So each of them genuinely believe that their project is a very good project. And that's why they would submit an optimistic kind of an assumption that comes in. This would also sometimes be plagued by what is called as inconsistent assumptions, right? There could be two divisions in the firm. There could be a marketing division that's making one assumption about the market share that a particular product might get, right? Let's say we're looking at an FMCG company, fast moving consumer goods company, and they are coming up with a new brand of soap, right? New brand of soap. Now, the marketing division might get a market share estimate, which is different from the actual product development team. The product development team might think that this is a very good kind of a soap and it should generate a high market share, but the marketing team might say that it will generate a low market share because of competition, right? Low market share because of high competition. And this is essentially going to lead into both the projects using different assumptions about some economic forecast, some market share kind of forecast, and that creates a little bit of an issue. It's important to kind of arrive at some sort of a consensus here. The third bit is there is centralized decision making. We just saw that the decision is made here by the senior management, right? Now, the senior management does not really have the time to go and look at each individual project in a lot of detail, right? So it's not able to review each project in details and thus relies on the forecast put together by different divisions. I mean, biased forecasts were okay if the senior management was able to kind of look at projects independently. But the reality is that senior management could possibly be looking at hundreds of projects. Now they can't possibly look at each of them separately, so they have to rely on what estimates come in. What are the solutions? There are some solutions available for biased forecasts and centralized decision making. Inconsistent assumptions, typically a good idea is to try and sit on the table and first arrive at some sort of consensus, some sort of an agreement on what would be potential market share estimates. And even then, if you're not sure, there are some mechanisms by which people could kind of deal with some of these basic issues that come up, right? So biased forecast, inconsistent assumptions, centralized decision making, that is what is causing some of the issues in capital budgeting. Now let's understand what can be done. So a manager could give a biased forecast, a middle manager, but that should be caught in the form of some sort of a post audit. So companies conduct audits after projects start to see if they are moving, on the right track in the right direction. This allows them to identify problems that need fixing and check the accuracy of some of the forecasts that have been used. However, you can find out the accuracy of forecast, you can identify problems, but the problem that does still remain that this is post facto analysis. This is analysis that happens after the event, right? So the project has started and you realize that the accuracy of the forecast is not good. So essentially questions that should have been asked in the first place before taking the project. But that doesn't necessarily give you a solution. It tells you what mistakes were committed in this project, what mistakes in this project, right? So that you can improve on the next project, right? So you essentially can improve on the next project. So it's important because it does give some sort of a feedback about what the accuracy of your forecasts and what are the key issues that come up when you're doing some sort of a capital budgeting exercise. But the reality is that for this particular project, this is after the event. So there is no use or no real use in this project, right? That's because you will know only after the problem has occurred. And that's where post audits have their own limitations. Nevertheless, post audits are kind of useful in terms of identifying problems on the longer run. It kind of works as a feedback mechanism for firms to kind of improve on subsequent projects after you have identified that a particular project has gone into some sort of a trouble, right? So the next stage that comes in is for any project, rather than taking just a post audit after you have assumed that certain set of data points have come in, you know that for any project there is a series of cash flow projections that are supposed to be done. Right now, these are projections that are made and they are futuristic in nature. It is not necessary that all the projections that you have for the future may hold true. It's therefore a good idea to do some sort of a range analysis or stress testing of these projections, which means you test these projections and say, okay, if I was making a market share assumption of 4%, what happens if the assumption is 5%, and what happens if the assumption is 3%, right? So this is essentially going to look for a range of values for the projection, and this is known as sensitivity analysis. It tests for the results of any change in the estimates that a company might do, right? Let's take an example. if you look at this particular example that we see, we have made, let's say, three sort of assumptions on market share. Best case, where a company is able to capture a market share of 5%. Base case, where a company is able to capture a market share of 4%. Worst case, where a company is able to capture a market share of 3%, right? Now, what also comes up for our understanding is that if the company is able to capture 5% market share, the cash flows for the next 5 years would be 500 crore each, right? The project has an initial outlay of 1700 crore. So initial outlay is 1700 crore. We can put this here in terms of initial outlay. So you have to put in this money, and then over a period you're going to kind of make some sort of money on this. In the best case scenario, you're going to make 500 crore each year. In the base case scenario, you're going to make 450 crore each year. In the worst case scenario, you're going to make 400 crore each year, right? The NPV is assumed on a cost of capital of 10%. So the firm can raise capital at 10%, and we are trying to identify what is going to be the net present value of the firm in this particular scenario. Now, if the NPV is 195, that's coming based on our calculations on this data point, that's assuming a best case scenario. Assume what happens if the base case is chosen. So if base case is chosen, all numbers would tend to 450, right? And in this case, now you see the NPV has gone to only about 6, which is just marginally positive. You're just in that territory where you can choose the project. If for some reason the worst case scenario plays out and you have only 3% market share, NPV turns negative, right? So this gives you an idea on what kind of range of values can occur so that your estimates can become slightly superior in nature. If worst case plays out, it is not a viable project. If base case plays out, it is just viable as a project. If best case plays out, it is obviously viable as a project, right? So that's an important part that we learn while looking at these data points, that we can get a range of values. We can get a range of possible outcomes that can get defined in terms of of the NPV value on testing our assumptions or doing some sort of sensitivity around our assumptions of market share, right? That gives us a slightly better viewpoint on, okay, if we think there is a risk of lesser market share coming in because of competition, then we may kind of say that it's not a great idea to possibly use this project, or there needs to be a little bit more clearer data available before we go ahead and take a project. On the contrary, there could be some project where even in the worst case you're making money, so it's easier to kind of select those kind of projects, right? There are still some issues, however. Capital budgeting, sensitivity analysis, it still creates a little bit of an issue, is because what exactly does best case or worst case mean? Do all departments view these numbers in the same possible manner? And if they don't, then how do you really go about clearly defining those? Also, sometimes the variables may be interrelated. So if the market share is lesser in the worst case scenario playing out, then it's also possible that demand is less. And if demand is less, pricing may also get impacted. So we said that in the worst case, you're going to have a 3% market share and a number of 400, but this 3% market share and this number of 400 may be interrelated because demand is lower. If demand is lower and pricing goes down, it's quite possible the number actually falls to 300. And that is not getting captured here because we are not really moving too many variables. In sensitivity analysis, we are basically playing around with one or two variables or inputs at a time. And because we are playing with only one or two variables or inputs at a time, it is fairly possible that interrelated variables, where let's say if market share goes down, pricing may also fall, those can create a lot of problems here, right? So if market share goes down, pricing going down, that is an issue that comes up in this kind of an analysis. So what do we do in this case? We turn our attention to something known as scenario analysis. Now, in scenario analysis, that's an extension of sensitivity on many interrelated parameters, right? So in this case, you'll create a scenario where you're looking at many interrelated parameters, such as, let's say, market share volume sold, and pricing, right? So you've said market share could be 5%, or let's put it here, 5% volume sold is, let's say, 1000, pricing is 10, 4% volume sold is 900, pricing is 9, 3% volume sold is 800, pricing is 8. Now you use all of these variables separately in terms of your input, right? So rather than doing a test on one parameter, now you're doing a test on many parameters. So if you're projecting, sensitivities using one or two variables, instead of doing that, we are looking at many interrelated variables that are being projected in various scenarios. Now you say best case scenario, worst case scenario, that basically projects a lot of parameters rather than just one or two parameters that we had done in sensitivity, right? So this eliminates one problem, which is if you see the movement of interrelated variables as seen in sensitivity analysis, that can be taken care of by scenario analysis. It does not eliminate the other problem where there is still no consensus about what is a good case and what is a bad case, right? That's scenario analysis. That extends with some more quantitative analysis that you could do with respect to calculating what is called as a break-even point, right? Suppose you manufacture these digital pens with which I am writing here, and following are the financials of the business. Selling price per pen is 50, variable cost per pen is 30, and fixed cost in the business is 10,000 rupees, right? Let's assume that is a fixed cost in the business. Now think about it. How many digital pens are needed to be sold in order to achieve break even, right? Let's do that analysis. Fixed cost is fixed. So in either case, whatever the number of units sold, fixed cost is going to remain fixed, right? Let's say you end up selling something like 1000 units. So what is the total sales you generate? That's 50,000. What is the variable cost per pen? That's 30,000. So this is subtracted. We end up with a profit of 10,000. Now break-even point is the point where we have zero profits and zero losses. We're just at the point where losses are turning into profits, right? So obviously that does not seem to be the case. Let's say what happens with 500 pens, right? So if you're manufacturing 500 pens, you make what, about 25,000 here. You lose about 15,000 here, and you subtract these and you end up getting zero. So 500 pens is the point at which you break even. Now, how do you get to the break-even point? Note, what are you making on every digital pen? Every digital pen is giving you 50 minus 30. This is known as the contribution you get per pen, right? So that's 20, right? Now, if one pen is giving you 20, you have to recover your fixed cost in the business. That's 10,000. So 10,000 divided by 20 is going to give you 500. In other words, if you use the formula of fixed cost divided by what are you making per pen, selling per digital pen, that's what your break-even point would be. So we can identify and write this formula as the total fixed cost in a project divided by selling price minus variable cost, right? That's what we did. We took 10,000 and we divided by 50 minus 30 because that's what you make on one pen, and that gives you the value of 500, which is your break-even point in this particular case. Now this analysis may also be useful sometimes because it does give you some sort of a sensitivity analysis. That's an extension of sensitivity analysis. Let's take an example on our Excel file. So let's look at this case. Same example that we have seen, right? I've just kind of changed things a little bit here, saying that there is an initial outlay now, right? So there's a fixed cost in the project every year, and you can put up a plant which kind of operates for the next 5 years. So with an initial outlay of 35,000, we're going to make, assuming that we're selling 1,000 units, we're going to make 10,000, 10,000, 10,000, right? At 1,000 units, what is going to be the output? That's going to be 20 rupees, right? So what's the sales number? Think about it. This into 1,000, that's going to be 30 into 1000, and fixed cost is fixed cost. So fixed cost stays at fixed cost, and we can format all these and sort of arrive at the number, which is 50 minus 30 minus 10. Let's assume this project entails taking an initial investment of 35,000, right? At a cost of capital of 10%, NPV is 2908. Now we can also say that break even point for this project is where NPV is 0, right? So effectively the project entails that you take this investment. 35,000 is kind of given. That's the initial outlay in this case, right? Initial outlay in this particular case. Now, what do you do with this initial outlay? Let's see if the firm produces only 900 units of these digital markers, then what happens? We find that NPV becomes negative, right? That's because the selling price and the amount that you're making, while you make 8,000 on each of the years, you're breaking even individually each of the year, but the initial outlay is creating a problem, right? So NPV becomes negative. Somewhere in between NPV should become positive, right? 970, you find NPV is positive, right? But 950, you find NPV is negative. What happens at 960? 960 also NPV is slightly negative, and 962 is where NPV is positive. So if you produce 961 pence, you lose money on this project. If you produce 962 pence, you make money on this project. So this effectively is your break-even point on this project, where NPV essentially becomes 0 approximately. That's where the NPV range turns itself to be positive at this given cost of capital. That's another range of analysis that could be done when you're kind of doing the capital budgeting analysis for any particular firm. So the break-even point analysis gives you an idea on what is going to be the production that you need to do in order to achieve financial viability to any given project. And then you can decide whether it's possible to produce 962 marker pens or digital pens every year, or it is not possible to produce those year on year, right? And then you also know that at what level does the project viability get questioned or threatened. So that's another analysis that could be done in terms of break-even points. Then we have something interesting, which is what we've just seen. The last interesting point here is going to talk about something called as real options, right? Now, recall our discussions on options. Options are derivative instruments that are the value of those depend on a contingent event, right? So, for example, a call of option is valuable if the underlying price crosses the exercise price, else it is worthless, right? We remember our discussion on derivatives. In real life, business conditions give such options to corporates. These options are termed as real options, right? It's called real options because they are in real world, right? And they are kind of some sort of options that are available. Companies have options to delay, to expand, to abandon projects as per their requirement. And the value also sometimes depends on contingent events, right? Consider two examples. Take the first example of an oil company with an exclusive right to an oil well for 10 years, right? Now, let's assume in the case one, the cost of producing oil, the cost of producing oil for the company is $80 per barrel of oil, right? $80 per barrel of oil. What is the market price of oil today? So market price of oil today is $40 per barrel of oil. So if you do an NPV analysis of this, it will give negative cash flows because your cost is bigger than your market price, which will mean it will give you a negative NPV, right? But what is the problem with the NPV analysis? The problem with NPV analysis is NPV assumes that your decision point is now or never. So you either take a decision now or you abandon the project, you leave the project. In real life, there is an exclusive right for 10 years, right? Now, crude prices today are 40, but what happens if after 2 years, this crude oil price goes up to, let's say, $100 per barrel? Does this oil well become valuable for the firm? So essentially, in this kind of a project, it's like it's effectively saying that your strike price or exercise price is 80 and your underlying price is the spot price, which is given here. And if the spot price crosses the strike price, the project could become valuable over its tenure of 0 to 10 years. And hence, basically what we are saying is that the value of this oil well, the value of this asset or development of this oil well depends on what is going to be the chances, the chances that oil price is above 80 anytime in the next 10 years, right? NPV does not capture this. NPV can only capture events which talk about the decision point being yes or no, and that's right now. You can't change it tomorrow, right? But in real life, these options are available with us. And basically, these are cases where you have to incorporate the probability of an event getting achieved, chances that oil price go above $80 a barrel, right? That's the first example. Let's look at the second one. Now, an airline company ordering aircrafts in the future, right? So let's say they have two options. They are saying we have to order 10 aircrafts, right? Now, this is today, and there could be two cases of business being good or business being bad, right? In the case business is good, they want to execute the order. In the case business is bad, they just want to cancel the order. Now, obviously, that doesn't work in real life because you have to go and talk to a guy who's giving you the aircraft, right? So there could be a company like Airbus that is giving you these flights or these aircrafts. So what could happen is that this airline company could enter into an agreement with Airbus and say we pay some amount today, right? We pay some amount today to get this option, right? To get this option that they can choose to either cancel or execute the order, right? The order might be worth $1 billion, right? Or 1,000 million. But the company might today pay something like $100 million to Airbus in order to get this option. So this $100 million here is nothing but the option premium that has been paid. That's in a sense, you instead of canceling, you could also delay the orders. So I will not execute this order now, I will execute it after 5 years. This option of paying $100 million today can give them a choice to buy or delay in case the market is good, right? So in case the market is doing, we end up in this scenario, they're okay leaving their $100 million. They don't care. That's the premium foregone. That's like a protection they'd bought. In case the market ends up being bad, they can delay the decision. They can say, we will now order these aircrafts after 5 years. And that's another example of a real option, right? Now, valuing of these options, how did we arrive at this price of 100 million? At this point of time, that is beyond the scope of what we are discussing. That probably will get discussed sometime in later stages of our course, probably in the second year. But at this point, that's beyond the understanding. What is important, however, is to understand that there are chances where in real world, you have these options that are available with the firm to delay, expand, abandon any project, or something that depends on contingent events like what will be the oil price at any given point of time in the next 10 years. These are the various kind of tools and options available with us where we can analyze what's going to happen with a particular project, what's going to happen with a project outlay, and that's what capital budgeting is all about. And just like always, we end with a couple of questions. Explain what is capital budgeting and the key issues with it, and explain sensitivity analysis.